So today I'm going to be talking about the benefits of setting up a trust. So firstly, setting up a trust is not for everybody. There are a range of complexities that you need to work through, and you need to make sure it's the correct structure for where you are in your point in your life, because there are additional requirements when it comes to compliance, tax returns, and the rest of it. So if you're unsure, feel free to reach out to me or reach out to your advisor to get more information about trusts. So today I'm going to be specifically referring mainly to property just to make the presentation a bit more consistent. But let's say you purchase an investment property in your personal name and you own it 100%. At the end of the year, when you do your tax return, the net income from that property will go into your tax return and you'll either pay tax on the income or you're going to be negatively geared and get a tax refund. Whereas if you own a property within a trust structure, you can actually determine where that income goes and to which beneficiaries at the end of the financial year. So you need to also be aware that the beneficiaries must be listed as part of the trust deed. You need to get them on as a beneficiary before the financial year ends. And on top of that, you need to ensure that the trust can actually distribute to them to start with. So let's say we have an investment property that generated 10 grand per year. In your personal name, that 10 grand would go 100% into your tax return and you'd pay the applicable tax on that 10K. If this was now in a trust structure, that 10 grand would actually be distributed to somebody, wouldn't necessarily have to be distributed to you 100%. You could swing it to other beneficiaries with a lower tax rate to make the structure a bit more tax effective. So this is what one of the main benefits is the option to distribute income to which beneficiary you require or that you like. So the same thing happens with capital gains tax as well. So if you have a different structure like a company, there is no capital gain tax discounts. This is only available to investors who own property in their personal name or via a trust. So what that means is when the property gets sold, the income or the capital gain from that property has to get pushed out to a beneficiary. And when it gets pushed out to a beneficiary, if that asset is owned for more than 12 months, there is a 50% discount on that capital gain. And this is applicable to trust structures as well. So this is one of the bigger benefits of this entity setup. You still get the CGT discounts that you would get if you own the asset personally. So another thing as well, so we've spoken about income, we've spoken about capital gains tax. The other thing is known as streaming. And this is where you can do the same as income, where you can distribute it to specific beneficiaries that you like with a lower tax rate. You can actually do the same thing with capital gains as well. So you can swing it to beneficiaries that have a lower income tax rate, and you can still get the capital gains discount, and you can still save on tax as a whole. The same thing happens with franked dividends as well. With the trust, you can actually push those dividends out to people with a higher tax rate or a lower tax rate, depending where you want to get the franking tax credits. So this is probably the third main benefit of setting up a trust. So let's go through an example. Again, it's a property example. Let's say John, which is on a tax rate of 47%. He gets net income from a property which he owns 100%. That 20 grand would be disclosed in his personal income tax return. He would pay 47% tax on that, which is his tax rate, a total of $9,400. If that same property was owned by a trust, it still generated 20 grand of net income. At this point in time, John can elect to put his wife, or if his wife is part of the trust as a beneficiary, he can elect to push some of those can push some of that net income to Jill rather than himself, because Jill is on a lower tax rate. So in this example, 20 grand from the property would still come in, go into the trust. At the point in time when they're doing the distributions, they would work out whether a zero would go to John, 20 would go to Jill, or whichever scenario that would be most tax efficient for them. But at the end of the day, because Jill is such a low tax rate compared to John, it makes sense to push the whole 20 to her, giving zero to John. John pays $0 in tax on $0 of income. However, Jill only pays 15% as on top of that $20,000 distribution. So you can see here exactly the same situation in terms of net income, but because we are allowed to income split basically, we've saved $6,400 in tax, resulting in exactly the same result for the family overall.